Hi everyone, welcome back. In this session, we're going to discuss on how to calculate the IRR for any investment. IRR is also known as the internal rate of return. Now, before we get into the complicated definitions of IRR, let me try and first explain you that IRR is nothing but the return on investment. When you invest a certain sum of money, you make a return on that, right? That is nothing but IRR. Let's take a very simple example. Let's say you go to a bank and open a term deposit of 1 year, right? You're going to a bank and opening a term deposit of 1 year, wherein you're investing about 1 lakh today and you're expected to receive 1,10,000 at the end of year one, right? So today you're going to invest 1 lakh and the bank promises to pay you back 1,10,000 at the end of year one. What is your rate of return on this investment? The rate of return is as good as 10%, right? Because you're investing 1 lakh and you're getting 10,000 on that additionally, which is nothing but 10%, right? This 10% is your IRR. IRR is nothing but the rate that you're earning as a return on the investment that you're making, right? But then there is also a classic definition of IRR, which is nothing but IRR is the discount rate at which your NPV becomes zero. Now, this is the discount rate at which the NPV actually becomes zero. Let me go to an Excel spreadsheet and explain you more. So what I've done on this Excel spreadsheet is nothing but I've just collated all the information that we actually spoke of. On year zero, which is today, which I've assumed as the 31st of March 2020, I've assumed a cash outflow of 1 lakh. And then at the end of year one, which is 31st of March 2021, I've shown that there is a cash inflow of 1,10,000. Cash outflow is being represented as negative numbers and cash inflow is being represented as positive numbers, right? Next, I want to calculate the IRR of this investment. Obviously, going by the cash flows, you're yourself able to say that the IRR is 10%. But in Excel, there is also a function, a formula, which throws the IRR given the inputs, right? The formula is nothing but XIRR. So you just press equal to XIRR. It then asks you for the values. Values refers to cash flows. So select the cash flows, and then it asks you for the dates. Then select the dates and then just press enter. It's throwing you the value of 10%, which we know is the right answer, right? So this is the Excel method of calculating the IRR. There is also another method, which is nothing but the classic definition that we saw. IRR is the rate of return at which the NPV is actually equal to zero. And now when is NPV equal to zero? NPV is equal to zero when the discounted cash inflow is equal to discounted cash outflow. Why am I saying that? Because you know that the formula for NPV is nothing but discounted cash inflow minus discounted cash outflow. We want NPV to be equal to zero, which means nothing but the cash inflow in today's terms should be equal to the cash outflow in today's terms, right? So now what I will try doing is I will show you that NPV at 10% discount rate is actually equal to zero. Okay, so I'm calculating the present value factor at 10%. Over here, I am using the formula equal to 1 divided by 1 plus R, where R is nothing but 10%, whole power. I'm just linking the formula to year zero, right? So obviously the present value factor of 1 rupee is 1 rupee today. And then I'm just dragging the formula. Let me just freeze the cells. I'm just dragging the formula. Now what this is doing is it's calculating the present value of $1 to be received at the end of 1 year. This 0.9091 is the present value of $1 to be received at the end of 1 year, right? So these are the present value factors. And now I calculate the discounted cash flows, which is nothing but the cash flows multiplied by the respective present value factor, right? And then I calculate NPV as nothing but the sum of these two numbers, and apologies. And the NPV is actually nothing but zero, right? Which means that if I discount the cash flows using the IRR, the NPV is actually zero. In other words, the IRR is nothing but a rate of return at which the NPV is actually equal to zero. The discounted cash inflow should be equal to the discounted cash outflow. I'll just re-summarize it. One, I said IRR is nothing but the rate of return that we earn on a particular investment, right? Here in this case, Obviously, the IRR was visible as 10%, but that's not always the case. In case of capital budgeting, where you have an initial cash outflow and you have series of cash inflows at future points in time, obviously you cannot calculate the XIRR just through your mind or intuition, right? One method of doing it is you find out the XIRR through the formula, wherein you have to input just the cash flows at different points in time, which is nothing but the cash flows and the dates. And then the Excel gives you the XIRR as the answer. And the second way is XIRR can be found out as the discount rate at which NPV is actually equal to 0, right? If there is a discount rate at which NPV of the project is 0, that discount rate is nothing but the internal rate of return, which means that is the rate of return that you're earning on an investment, right? Now, let me quickly take you actually through a capital budgeting example as well. I've assumed a 5-year project. At year 0, which is let me keep it as 31st of March 2020 for the sake of convenience. At 31st of March 2020, I have a cash outflow of 1 lakh. And then at the end of each year, I have a cash inflow of 25,000, 30, 40, 20, and 30,000, right? I have a cash outflow today of 1 lakh, and then I have a series of cash inflows for a period of 5 years, right? One way of calculating XIRR, like I said, is using the Excel function, which I'm using right now. As XIRR, it's asking me for the values, and then it's asking me for the dates. Then I just close it. It's saying that the XIRR is 13.76%. This is nothing but the rate of return that you're earning on the investment of 1 lakh. Your return is 13.76%, right? Now, if I want to actually verify whether this is right or not, I know that XIRR is nothing but the discount. If I plug in this as the discount rate for calculating NPV, the NPV should actually be equal to 0, right? So what I'm doing is I'm calculating present value factor at 13.76%. Okay. Again, I'm using the same formula that I used in the previous spreadsheet, which is 1 divided by 1 plus R, where R is 13.76%, raised to the year. Let me just increase the decimals. I think I didn't freeze it over here. Let me just freeze this as well. Yeah. Okay, so these are the present value factors. The interpretation of 0.6792 is $1 received at the end of year 3, which is at the end of 31st of March 2023, is equal to $0.6792 today, which is 31st of March 20, right? Given that the discount rate is 13.76%. Now, if I calculate the discounted cash flows, which is nothing but cash flow multiplied by the present value factor, if I just calculate NPV quickly, it will be NPV is almost equal to 0. It's not exactly equal to 0, probably because of some rounding differences. All right. So if I calculate the NPV using the IRR, that IRR is nothing but the return. That NPV should actually be equal to 0. And the IRR is nothing but the rate of return that I earn on a particular investment. Right. So if given a pen and a paper kind of examination, obviously you cannot use this Excel formula. What they would do in that case is they would give you the present value factors at 13%, and they would also give you present value factors at 14%. And then you have to calculate through interpolation the present value factor at 13.76%. This is what you might have precisely done as part of your earlier chapters in capital budgeting, right? They're indirectly, when they give you the present value factors at 13% and present value factors at 14%, they're trying to give you a hint that the IRR is actually going to be somewhere in between the two, right? So if in case, let me just show it to you. Sorry, give me a second, guys. So if I calculate present value factor at 13%, it would be 1 divided by 1.13, the whole power, again, of course, n, right? I drag this, and now I'm calculating the discounted cash flows at 13%. If I calculate the NPV is slightly positive. It is 1,889. And now if I calculate the present value factor at 14%, And then the discounted cash flows at 14%. Over here, it's slightly negative. So at 13%, the NPV is slightly positive, and at 14%, it's slightly negative. Through interpolation, you can basically find out the discount rate at which NPV is going to be zero, right? Because you have a range of minus 565 to 1,889. You now need a discount factor which would ensure that the NPV is actually zero, and that discount factor is nothing but 13.76%. Now, at this discount factor, since the NPV is actually equal to zero, this is the internal rate of return, or nothing but the rate of return that you would be earning on this particular project, right? If I move quickly back to the PowerPoint presentation. So the classic definition of IRR is the discount rate at which NPV becomes zero. But remember, at the end of the day, IRR is only nothing but the return that you're earning on a particular project. Don't go by the definitions and get confused. IRR is nothing but the return that you're earning on a project. But since return cannot be computed just through mind, the definition of calculating IRR is nothing but the rate of return at which NPV is actually equal to zero. Now, if you look at bonds as well, bonds is also a typical capital budgeting exercise. Why do I say that? In case of bonds as well, you have a cash outflow at year zero, and then you have a series of cash inflows for a particular time frame in the form of coupon, and then you have the face value that would be paid to you at maturity. It's a typical capital budgeting exercise, right? The only difference is in case of capital budgeting, you had uneven cash flows, meaning the cash flow in year one was 25, in year two it was 30, in year three it was 40, and so on. Whereas in case of a bond, the coupon is generally equal every year. That is the only difference between a capital budgeting exercise and a typical bond that we see. So you can also calculate the IRR for a particular bond. The only difference is IRR is going to now be called as yield to maturity. Now, if you carefully look at the word, it says yield. The meaning of yield is nothing but the return, right? IRR was also the rate of return on an investment. YTM, or the yield to maturity for a bond, is also nothing but return, right? It is the return that you would be earning when you invest in that particular bond, but it's called as yield over here. And then there is something called as to maturity. What we're trying to indicate by to maturity is if you buy the bond today and also hold it up to maturity, then this is the return that you would be earning on that particular bond. For example, a YTM of 7% means if you buy the bond today at the market price which is prevailing, and then you hold the bond until maturity. What I mean by you hold the bond until maturity, which it means that you're receiving coupon every year for the next 5 years, and you're also receiving the face value at maturity, right? So if you buy the bond today at the prevailing market price and you hold the bond for 5 years, during which you will receive coupon and the face value, then the yield, or nothing but the return that you would earn from the bond, is 7%. And that return that you're going to earn from the bond is going to be in the form of coupon and in the form of capital gain or loss, because you might be buying the bond today at 90, whereas you would be receiving 100 at the end of year 5, given that it's a 5-year bond. So there is a capital gain component of $10. And in addition to that, there's also going to be a coupon, right? So yield to maturity, be clear, yield to maturity is nothing, not the coupon. Yield to maturity is the return that you would be earning. And this return includes the coupon plus any capital gains, right? It would include coupon plus capital gains or any capital loss as well. Because if you are buying a bond at 110, then you have a capital loss of $10, right? So this YTM of 7% has two components. One, the coupon, and second, capital gain or capital loss. You cannot have both capital gain and capital loss in the same scenario, right? So YTM of 7% for a 5-year bond basically means that if you buy the bond today at the prevailing market price and you hold it up to maturity, you're going to earn a return of 7%, right? The most critical component is holding it up to maturity. This will not be your return if you sell the bond after 1 year, okay? This will be your bond return only if you hold the bond up to maturity. Now let's take the example that we had the price of a bond as 900, the coupon was 8%, the face value was $1,000. Now I want to calculate the return that we will be earning from this bond. When I say what is the return I would be earning from this bond, obviously the return is nothing but the IRR. IRR in this case is nothing but YTM, right? IRR is called as the YTM of a bond. I believe I did not take the term of the bond. Let's say the term of the bond is 5 years, right? Let me just add it. Give me a second. Okay, let's say that the term of the bond is 5 years, and now you are required to calculate the return on this investment, or nothing but you are required to calculate the YTM of the bond. Let me quickly move to the Excel spreadsheet. So let's say we have year 0, year 1, year 2, year 3, year 4, year 5. We have the dates. I'm keeping the dates as is because to calculate XIRR using Excel, we need the dates as well. I cannot give the input as 0, 1, 2, 3, 4, 5. I need the dates as well, right? So I'm keeping the dates as is. In this case, I've said that the current price of the bond is 900. The coupon rate is 8%, which is nothing but 80, which is 1000 into 8%, which is 80. So I received 80, 80, 80 for 5 years, for 4 years, and in the last year I received 1080. 1080 being the face value plus the maturity, the face value plus the coupon that I receive on maturity. Now the XIRR, using the formula that we already had, it's saying that the XIRR is 10.68%. This means that if I invest in this bond by paying 900 today and I receive 80 at the end of each year, and then I also receive face value of about 1000 at the end of year 5, the return that I would be earning is 10.68%. If you actually carefully notice, the bond is paying me only a coupon of 8%, whereas I am earning a return of 10.68% by investing in this bond. How am I able to do that? I'm actually having a capital gain. The capital gain is the difference between 900 and 1000. So I'm having about $100 or 100 rupees of capital gain that is getting built up over a period of 5 years. So in addition to the coupon of 8%, I'm also receiving a capital gain of $100, which if I spread it over a period of 5 years, it's approximately $20 per year, right? So I'm receiving $80 worth of coupon and $20 worth of capital gain on a per annum basis. And that is driving the internal rate of return, or the YTM of a bond, of 10.68%, right? That's how you calculate the IRR or the YTM for a particular bond. Now, obviously, I've done the method 1, which is nothing but the Excel spreadsheet. You have 2 other methods, which is nothing but the trial and error method of what you did in the capital budgeting, exactly like what we did in the capital budgeting example. And then there is a simple approach as well, which is going to be a subject to a little approximation, the hint of which I've actually given in this lecture already, right? Method 2 and method 3, I would be taking it as part of the next video lecture. But before I end this lecture, I have a simple question for you. If my required rate of return, right? I have a required rate of return of 11%, which means when I'm investing in this bond, given the risk characteristics of this bond, I want a return of 11%. The bond in the market is offering me 10.68. We actually calculated the IRR and we saw that the answer was 10.68%. Now the question is, will I buy the bond or will I not buy the bond? The answer obviously is I shouldn't be buying the bond, because the bond is giving me a return which is less than what I want. I want 11%. The bond is offering me only 10.68, which means I should avoid buying this bond. And if possible, I should actually sell the bond in the market, right? So that's it for this lecture. In method 2 and method 3 will be revisited in the next session. And from there on, we will carry on the discussion of how I calculated the required rate of return. If you remember, I postponed the discussion of what this required rate of return is. Okay, after we complete our discussion on IRR and YTM, we will then move to calculating the required rate of return when you invest in a bond. Thank you guys. Bye.